Hello, and welcome to UFile's Let's Talk Tax, where we teach you to be more efficient with your taxes. My name is Jerry Viteratos, National Tax Specialist with UFile, and today what we're going to talk about is tax planning for your investments at the end of the year. Now, by investments, what we mean are your taxable investments. In other words, your investments that you have in non-registered accounts, meaning these are not in your RRSP and these are not in your TFSA. So let's get to the tips for tax planning at the end of the year. Tip number 1, hold on to your winners a little while longer, meaning do not sell your winners by the end of the year. Wait for the new year. Now, why do I suggest this? Very simple. The concept of tax deferral, meaning that when you declare your tax return, when you produce your tax return every single year, you are declaring the income that you've gained from January 1st of the year till December 31st of the same year. You have to pay your taxes by April 30th of the following year. Should you sell your winning investment within the next few weeks, within the month of December, well then what happens in that case? You have to pay the tax on that capital gain by April 30th of the following year. Should you wait to sell this winner by January, well now you're in a new year, meaning that the only time you will have to pay that tax will be April 30th of the following year. Let's take an example. I've got a winner right now in my hands and I want to sell now. We're December 2021. If I sell the stock in December 2021, now I have a taxable capital gain to declare for my 2021 return. And I have to pay that tax by April 30th of 2022. Remember, we have the first 4 months of the following year to file our tax return. Should I wait to sell this stock in January 2022? Well, my tax return for my 2022 tax year is only due in the following year, meaning 2023. So I have until April 30th, 2023 to pay the tax on the capital gain. So just for a couple of weeks, just by waiting a couple of weeks, you are deferring your income tax by 16 months. Now that's a winning deal. Tip number 2, sell your current losing investments in your taxable accounts by the end of the year. Now, why would you do that? Maybe there are some investments you want to keep that are currently at a loss position, but you want to keep these investments long term. It doesn't matter. You can still sell them and repurchase them later on. The purpose of doing this is a tax strategy that you commonly hear of, which is tax loss selling. Now, what is tax loss selling? Very simply put, you are creating a capital loss, a deductible capital loss, to use against your taxable capital gains. Let's try an example to understand the concept. So you have a winning investment that you sold earlier in the year for about a $4,000 profit, let's say. Remember that capital gains are taxable at a 50% clip on your tax return, meaning you're only going to pay tax on 50% of the income. So in my example of the $4,000 gain, I will declare now a taxable capital gain of $2,000. So my income has increased by $2,000. Now, I also have in my taxable account a losing investment currently of about $2,000. So if I were to sell today, I would incur a loss of $2,000. So under the tax loss selling strategy, I would sell this stock now before the end of the year because I want to harvest that loss. I want to create that loss in order to use it against my taxable capital gain. So I sell it today before the end of the year, and now I've incurred my $2,000 loss. And of course, my deductible portion is 50%. Okay, it's both sides of the coin is 50%. So I have a deductible taxable capital loss that I can use against my taxable capital gain of $1,000, 50% of $2,000. Now, nothing prevents you from rebuying or repurchasing that losing investment later on. But there is a catch that I'll get to in a minute. Let's get back to my example. I've got a $2,000 taxable capital gain. I just sold my investment and I've created an $1,000 capital loss. So in this case, I've now reduced my taxable capital gain by $1,000. $2,000 minus $1,000 deductible capital loss, and I only have an $1,000 taxable capital gain to declare instead of $2,000. That's my tax loss selling strategy. And then later on, I'll just repurchase that losing investment and continue to invest in it. Now, there's a catch to this strategy. And the catch is a rule that the government has created, which we call the superficial loss rule. Now, what is that superficial loss rule? Everything I've just done right now is perfectly legal. I can sell my losing investment today in order to use the loss against my gain for the year. But in order to make my loss deductible, I have to wait 30 days before I repurchase that same investment. So that investment that was losing money that I sold at the end of the year, if I want to make that loss deductible, I have to wait at least 30 days before I repurchase it. And just for good measure, the government applies this rule to individuals that are related to you as well, meaning your spouse. So let's say you want to pull a fast one on the CRA and say, well, you know what? I'll sell my losing investment now and I'll have my spouse purchase it the next day. Well, guess what? You just got nabbed in the superficial loss rule. Because your spouse repurchased that losing investment, you cannot deduct that loss. So the key here is the 30 days. You have to wait 30 days before you repurchase that losing investment that you sold in December. That's the superficial loss. So let's go through the steps, okay, in order to apply the tax loss selling strategy. Step number 1, sell your losing investment by the end of the year. Step number 2, wait 30 days. Step number 3, after the 30 days, purchase or repurchase in this case, that investment. Step number 4, on your tax return, apply now the deductible capital loss against your taxable capital gains. And here comes the dad joke. Step number 5, rinse and repeat. I hope I didn't lose you on that one. Tip number 3, supercharge the tax loss selling strategy that I just mentioned before by repurchasing the same investment in an RRSP or TFSA account instead of your taxable account. Now, why are we supercharging? It's because you are creating, for example, with an RRSP account, a deductible contribution on top of it. So not only are you creating a deductible capital loss that you can use against your taxable capital gains to reduce your tax bill, but by repurchasing that same investment in an RRSP account, now you've just created an RRSP deduction to boot. Now, if you do the same strategy with the TFSA, unfortunately, you won't have a deductible contribution to declare with the TFSA. However, you are sheltering any future taxable capital gains, meaning that any capital gain you would create with that investment in your TFSA account would be tax-free. In your RRSP account, you are deferring the taxation of any future gain within your RRSP account until you retire and when you need to start pulling out the funds when your RRSP account gets converted to a RIF. So that is literally win-win-win. So we hope you enjoyed this video. We hope it gave you some really great tax tips and tax planning for the end of the tax year. Please like, and if you like the video, please click on the like button. Please subscribe for more of this type of content. We are definitely looking for topics as well. So if you have any topics you would like to suggest, please leave it in the comment below. A lot of the content that I just mentioned in this video is found in our UFile blog, which we will produce the link in the description of the video. Thank you very much for watching.